In today's video, what I want to do is walk through an introduction on the options wheel strategy for beginners. And for those who are new to my world, I am the 2019 US Investing Champion, author of the best-selling book, Option Trading Made Simple, but I go by Trader Travis online. And I was fortunate enough to achieve financial freedom when I was 34. And so since about 2009, I've been online teaching people the principles to how I did that. And today's video, what I want to do is walk through, it's a new strategy. It wasn't around, well, the concepts was around when I first started back in the early to late 90s when I first learned about option trading, but it's been hyped up a lot online, and it's the options wheel strategy. And so I'm going to load up a video I recorded for members of a beta trade alert service I started. Now, if anybody knows me, that you're completely surprised because for like 10 years I've been completely bad mouthing trade alert services. I'm like, they're all scams. I have videos on it, but I've grown, I've matured, and I had coaching. And one of the coaches was like, you could be wrong about this, and he shared like different viewpoints of how he viewed trailer services. It's kind of a helping hand up. It can help people bridge the gap and learn on their own. And I am never one for holding anyone back, right? I don't want to be wrong. Well, I don't want my negative head trash to hold anybody back financially. So I was willing to do a test run of a beta trailer service. So the video you're about to watch, it was actually one of the training videos in that program where I was walking through the wheel strategy. And as I walked through it, I was like, you know what, this is probably good for beginners or for the general public because there's so much hype about the wheel strategy, and people make it more complicated than it is. And so I figured, hey, I'll put my video out there so you can see my perspective on the options wheel strategy. So let me load up that video, and I hope you enjoy it. So I'm going to use UPRO, but the strategy I'm going to use is something called the wheel strategy, and here it is right here. I'm going to implement it first, and then I'm going to try to clean this up and write the steps, and I'll put it below one of the videos in this members area. But basically, the wheel strategy is you sell cash secured puts, right? A cash secured put, when you sell puts, let's show you this. Let me show you this. If I sold this 40 put right here, if you understand option basics, right? Puts, when you buy a put, it gives you the right to sell a stock at a set price. But when you sell puts, it's the opposite. You don't have rights anymore, you have obligations. When you sell a put, and I'll sell this 40 put, I am obligated to buy 100 shares of UPRO at this strike price of $40. So 100 shares times $40 means I would have to cough up $4,000. Cash secured put means I have the $4,000 in my account. That's all selling puts are. You sell it, you're selling puts saying, hey, I want to buy stock. In exchange for selling those puts, you're an insurance company. You're insuring somebody else's account. Maybe whoever bought this put is insuring their account. You're selling insurance to them. Just like an insurance salesperson, you get cash, premium, $110. We'll focus on percent returns and stuff later. So that's all selling puts are. You're selling insurance to other investors, you're getting cash. Well, eventually you will have to buy the stock per the terms of the agreement. You're going to buy stock. Once you do, you jump on the other side of the aisle here and you start selling calls against it. It's called covered calls, right? A covered call, when you buy a call, you have a right to buy a stock at a set price, right, people? And I covered examples in my book, Option Trading Made Simple, why stock investors will buy calls, right? But when you sell a call, it's the opposite. You don't have rights anymore, you have obligations. You have an obligation to sell your stock at a set price. So if I bought the stock at $40, I might sell a covered call, a call option at 41, and I'm telling other investors, hey, I'm willing to let go of my stock at the price of $41. In exchange for giving them those rights, they pay me a premium of $15 or, whatever premium I can get. So I'm getting paid to sell my stock. That's the third step. Now, the fourth step is rinse and repeat, and that's where they get the wheel. You just go in a circle here. You just repeat these three steps over and over again. And so I guess that's where they came up with the term wheel, because when you sell cover calls, eventually you will have to sell your stock. And when you do, you're back in cash and you just rinse and repeat. Alrighty, this is Travis, and I am back with a continuation of this wheel strategy case study. This is going to be part 2 of the wheel strategy, so now you can see the second half of the wheel strategy. And I will only focus on the traditional wheel strategy. I'm trying my best not to integrate too much talk of the enhanced will strategy I'm actually showing you, because the enhanced is my version, and I've already explained in another video why I show the enhanced version is because the traditional will strategy, doesn't, really satisfy my three commandments of investing success, protection, growth, and income. It's incomplete strategy. But I still want to teach it to you because a lot of people are confused about the will strategy. They've maybe heard about it, heard it's so awesome, and I just want to show it to you and try to leave my biased opinions aside. Also, I plan on writing a book about it one day, and you get it now. Like I probably will even use this case study in a book. But before I'm a slow writer, so it's probably be a couple of years before I get that book out. But you get to learn it now before the book is out, and you get to ask any questions along the way. All right, so part one of the will strategy, and I'll summarize this on a document here after I place this trade because I have 15 minutes until the market closes. So I want to place this cover call trade here. So part one was selling cash secured puts, and again, I'll summarize what a cash secured put is on a document here in a second. Basically, I was selling puts to get assigned to have to buy stock, and now I actually have 100 shares of stock in my account. So that's where once I get assigned and I own stock, that's where I move to part two of the will strategy, and that is selling covered calls, right? They're called covered because you own stock shares. And again, I will summarize what a covered call is on a document. But the big picture overview is I am now going to sell another option and bring in even more income. Previously, I was over here on the right side selling puts. I was going about a week out in time, selling them, at the money or at where the stock was at or slightly lower than the stock. Right now, I own stock. I jump over here now to the call side and I sell another set of options. Oh, I'm on SPY. I might want to put it to UPRO, right? But regardless, I jump over here on the other side, and now I'm selling options to bring in even more income. But the rights, obligations, like what that actually means, the translation of what I'm doing changes now that I'm on the other side of the aisle. So you'll see that when I summarize it here in a document. But you're just going to watch me place this trade. It shows that I bought the stock at 40.50. And so now I come over here, and when I sell a call, what I'm telling someone is, hey, I am willing to give up my stock and sell it to you. I'm willing to sell my stock to you. I'm willing to give up my asset, right? It's like lease purchase on a home. You've ever heard of people renting to own? They rent a house. At the end of their rental lease, they have the option to buy that house, right? The landlord gets to keep, if they buy the house, the landlord gets to keep all that rent they've paid over the years. Sometimes they, credit some of the rent to the purchase, but regardless, if they do or they don't, the renter rented for X number of years. They decided to buy the house. The landlord got to keep all the rent. That's what I'm doing here. I'm saying, hey, you can rent out my stock for the next 4 days, right? At the end of those 4 days, you can decide to buy my stock from me or not. Irregardless, though, I'm keeping your rent money. So I showed you this purchase price here because the rules I follow is I'm only willing to sell my house, my asset, for exactly what I pay for it or more. So following those rules, I can sell the 40.50 or the 41. And it's really just that simple, right? I decide whether I want to make, 10 cents over the next 4 days, or do I want to make 5 cents over the next 4 days? That's what it comes down to. And so I am going to take the more conservative route. If the stock UPRO happened to jump up in the next 4 days, I'd rather sell it for about 50 cents more than I bought it, and I still get income. So I get income and capital gains. If I sold the 40.50, I would just get income. I would just get this $10, right? And that's the most I can make. And I just sell my stock exactly what I bought it. Still didn't lose money, but that limits my profit potential. So I try to do a little, it just depends, right? But in this particular situation with 4 days left to expiration, I'm just going to sell the 41. So I'm telling somebody, hey, I'm willing to sell my stock to you for $41 in exchange for receiving $5. This $5 is mine to keep. I don't give it back. And it's for 4 days worth of work. And again, it depends on how you look at this. Let's say I could do this every week. That's $20 divided by, how much I have tied up in the stock. And that's going to wind up being a 0.4% return for the month. that's just focused on these $5 premiums, which they will fluctuate. Sometimes it'll be 5, sometimes it'll be 10, sometimes it'll be 15. But it's excluding any capital gains, because I can't plan on capital gains. I don't know if the stock would jump up or not, if this is the only money I'll make. If I don't like the $5 for 41, I could come out 11 days and then sell the 41 and I get a lot more money. I actually get $25. And so that's actually looking pretty decent. And, I also get an extra $5 capital gains. I might do that next time around. For now, I just want to do a short-term trade because I'm just showing you, what a cover call is. And then come, May 19th, then I might go out a couple of weeks and then it'll give me a chance to record another video for you. So anywho, let me stop rambling. Let me sell this, bring in my $5 and be happy with it. Okay, so that's done. Let me whip up some notes for you and I'll summarize what's going on here. All right, I'm back and I have the rules and the wheel strategy summarized here. And just FYI, depending on who you learn this from, it could look entirely different. I've seen I've wrote it in the most simplified manner. Well, probably not the most simplified manner. I wrote it in a simplified manner, the way I think of it. But depending on who you learn this from, it could look entirely different. Like I've seen the wheel strategy explained in as much as 11 different individual steps. So you can make this as simple or as complicated as you want, but this is the basis of what they call the wheel strategy. Think of a wheel, you're going in circles. So let me walk you through what I did, right? So far, you've seen me, step one of the wheel, right? It always starts with, well, at least the way most people teach it, it always starts with step one. You sell a cash secure put, right? If you understand option basics, we're not going to talk about buying puts. We're talking about selling puts. When you buy puts, is basically buying stock insurance, right? But here, you're selling stock insurance to someone else, right? Now, your risk is that you're obligating yourself to buy stock, right? And like any insurance, you're obligating yourself to pay off a home if it burns down or get in a car wreck, etc., etc. Just like someone who sells insurance, right? You're paid an insurance premium in exchange for taking on that risk, the risk of potentially buying stock. Well, with step one, only two things can happen. You so far have only seen 1A, right? All of the puts I sold either expired worthless or I bought them back once I achieved 80 to 90% of the max profit, meaning 80 to 90% of the credit I received. When that happens, I repeated step one. I just sold another put. Here's the Excel. Let's see, I have it separated out. So here it is right here. So this is the cash secure put for the wheel strategy. The first one, whatever reason, my good till cancel order didn't fill, so that one expired worthless. But the second cash secure put I sold did wind up, my good till cancel order did wind up getting filled. Then I sold this 40/50. Now this one did in fact get filled and I had to buy stock. So all of that you saw was step 1A. Either the put expired worthless or I bought it back. Now we're moving on step 1B. My put was assigned, and the rules are when I have to buy stock, I proceed to step 2. That's what you saw me do. My rules I follow, and everybody teaches this different, but maybe in the next video I'll explain why my rules are like this, but my rules are sell a cover call at or above my purchase price. I purchased it for 40/50, so I want to sell a 40/50 call or higher. And what that means, the translation is, I am letting someone rent to own. They're renting my stock for X number of days with the right to buy my stock at the end of the rental period or the lease period. Now, at the end of the rental period, they can either buy the stock or not. And I am paid rent in exchange for giving them the right to buy my stock. Now, 2A, same deal here. I just sold a cover call. You just saw that. Only two things can happen. Same deal with the put. Either that call is going to expire worthless or I'm going to buy back once it achieves 80 to 90% of max profit. I am not putting a good till cancel order for my cover call because I only received $5. So I'm going to potentially let mine expire worthless. But maybe it won't. Maybe the stock will shoot up. In that case, 2B will happen. The call expires in the money. The stock shoots up to 41. I sold someone the right to buy my stock for 40/50. They can buy for cheaper than what it's trading at. You think they might exercise the rights of that call? Yeah. And I'll be forced to sell my stock at the call strike price, irregardless of how high the stock goes. That's the downfall of covered calls. And I will walk you through how to overcome those downfalls in another video. But if that happens, right, and I have to sell my stock, I return to step 1. That is the wheel. We're circling back to the beginning and completing a loop. So there you have it. Wheel strategy summarized, again, depending on who you learn this from, it could be a little bit more complicated, but that's the simple way I look at it. And I generally don't use this strategy. I'm like, I don't sell. If I don't want to sell puts to get a son stock, right? If I want to buy stock, I just simply buy the stock. I don't have to go through all the work of selling puts, right? It just creates more work. I'm like, if I want to buy the stock, I just simply buy it. But there is a purpose for selling puts, and that is what I do for income, and that may be shown in a case study moving forward. So, anywho, that's all I have for this video. You take care, and I will see you in the next case study update. Bye bye.